everyone. It's the time of the day when we tell you about everything that's buzzing in the startup space. I'm Priya Sheth, and a very warm welcome to all of you to the Daily Dispatch. On today's show, I'm going to be talking about the top 3 companies that have been in news today, and these include Ola, Gupshup, as well as Minimalist. Well, headline number 1, IPO-bound Ola plans to expand its employee stock options pool to 3,000 crore rupees. The company is also allocating an additional 400 crore rupee worth of stocks to employees in the run-up to its IPO. Now, earlier this month, Temasek Holdings as well as Warburg Pincus invested a combined $500 million in ANI Technologies, which runs Ola. Well, after securing $100 million in April this year and entering India's unicorn club, enterprise communications startup Gupshup has raised an additional $240 million in a follow-on funding round, and more than 100 employees of Gupshup managed to sell shares to the public market investors in this round. Now, Gupshup will be using these funds to explore acquisition opportunities to fill existing product gaps in its portfolio and expand into adjacent spaces. Well, headline number 3, the final headline of the day, skincare startup Minimalist has raised about $15 million in a Series A funding round led by Sequoia Capital India with participation from Unilever Ventures. The funds will be utilized for global expansion besides enhancing infrastructure, research and development capabilities, as well as content curation. Now launched in 2020, Minimalist claims to have served more than 1 million customers. Alright, then moving on to our second segment, I have with me a power-packed panel, and the topic of discussion today is the 3-letter word that is taking the markets by storm, which is IPO. And we're seeing a lot of new age companies going out there and listing. And to discuss this, I have with me Siddarth Pai from Capital, Devang Mehta from Anthill Ventures, and Kashyap Chanchani from the Rainmaker Company. Thank you very much, gentlemen, for joining us today. I want to begin with you, Kashyap. You've taken a lot of companies public. You've worked on pre-IPO rounds as well. Run us through what is the rationale? Why is everybody going public at this point in time?
No, thanks. And that's a very, very pertinent question. If you ask me, there are 2 or 3 reasons, when companies go public. One is that when, the markets are predictable, markets are good, which is the case right now. The second is when there is a need to go IPO from the shareholders' perspective. And the third is when the companies are really prepared, to take that leap and, become a public company where they're a lot more accountable, on a Q-on-Q basis to the incoming public shareholders, where there is a lot of scrutiny. And, the ideal time for a company to go public is when, at least the first and the third, so to say, circumstances are in place. And for a lot of companies, in India, I think these are coming together. I think the classic example would be Zomato, right? I think Zomato was probably the most prepared company in our entire ecosystem to go public. Because they had the good fortune of having, Info Edge as a shareholder. So for a long time, Zomato had, probably been a quasi-public company. There was a lot of scrutiny. There was a lot of excitement around the company because whatever the company did, whatever happened to the company had a lot of implications for Info Edge's share price. So, they already learned things the hard way, years before they went public. They used to make their financials and numbers public. Their founding team used to come, in public fora very, very often and talk very, very transparently about their numbers. So, in that sense, they were a lot more prepared than, classic venture-backed companies to go public. And obviously, markets right now were great. And you saw what happened, a phenomenal response.
Right. Devang, I want to bring you in out here talking about, the kind of response that these IPOs have been getting, and Kashyap alluded to it. Zomato has seen huge gains on listing, and I want to understand from your perspective, from the perspective of an investor, do you think it's the right time for a company to go public? Do you think that the current market scenario, and I want to bounce this question off to you, Siddarth, as well, to understand whether this is a good time from an investor's point of view for a company to go public. So Devang, if you can just go first.
Yeah, I mean, the answer is multifaceted. Right time, the public stock market is clearly doing really well. So from a liquidity and a multiple standpoint, that's part of the answer. It's a great time to go public. Now, early stage investors like us who invest in pre-series A and Series A, who stay on till a liquidity event like this will of course make fantastic gains. So, from a validation of the whole ecosystem standpoint, it's a great event that companies are able to raise money. I think one thing that has changed in recent times, it looks like that Indian investors are now more mature to look at growth metrics aside from profitability. Historically, we've been a conservative society, a conservative market where profitability is a must for 3 years, 5 years to go public. A lot of those norms have been relaxed by SEBI. So I think SEBI has at least made some decent steps to understand how a tech sector works. I mean, the best example is Amazon that was public on the on the Nasdaq for at least a decade, and still unprofitable, and still a fantastic stock story of all time. So tech is different. Profitability is not necessarily the best metric to judge growth. So I think as long as regulators and SEBI and the broader market understands this, it's a great time to go public.
Siddarth, you want to come in there?
So Priya, I think the one thing, one of the greatest factors actually affecting the entire mood that's happening right now, I believe, come down to two. Number one actually being because of the COVID-19 pandemic. The Federal Reserve in the US has actually pumped an unprecedented amount of liquidity throughout the entire system. And there's so much liquidity sloshing throughout the entire system right now that growth rates and interest rates throughout the entire world have actually collapsed and crashed. All of us have seen in 2019, into 2020 itself, where growth almost came to a standstill and the entire world went into a lockdown. As the world actually emerges out of this, the technology and digital access actually became one of the key ways through which people actually navigated the entire pandemic. And the propensity of people to actually value technology as of now is actually at an all-time high as well. So when there's so much liquidity around the entire world and there's very low interest rates, everyone's actually chasing growth. And technology has the greatest promise of growth as one of the drivers driving us into the 21st century, as well as the time actually going beyond. We've seen this happen in the US as well, where a slew of tech companies actually went IPO. There was a dip, but now all of them are actually started roaring back as well. And for the Indian consumers also, the most important thing that's happening is all the companies that we've actually grown up with, be it a Paytm, be it a MobiKwik, a Policy Bazaar, a Zomato, a Nykaa, whoever else. These are companies for which we're consumers. We've seen their services. We can attest to that. We continue to be lifelong consumers. So a lot of buoyancy that's also emerged into the market along with that. And along with this, as both Devang and Kashyap have also said, profitability is no longer one of the key criteria for which people actually value this. There's always been a dichotomy between profitability and growth, where people have had to sacrifice one for the other. And now most of the investors have seen how VCs such as Devang and myself, and even bankers such as Kashyap, actually value all these companies coming forward, where the cash flows that the company actually generates, especially the operating cash flows, matters a lot more than the true profitability that they have. And the growth they keep compounding with thereafter allows them to take a larger chunk of the entire market and then stabilize operations. We've seen this happen in the US. We've seen this happen in a few cases in India as well. So this has become the template for all investors, be they retail investors as well as HNI investors, to start valuing all these particular companies. And it's a combination of the pandemic, combination of a large amount of global liquidity, confidence that investors have seen other companies in other jurisdictions deliver similar kind of returns. And the fact that all of us are now familiar with these companies is what's causing a large number of these tech startups in India, especially look at the IPO market also.
Just adding to Siddarth's point, which was very, very valid. See, the truth is that, a lot of these late stage companies, unicorns, which are probably, or have been rather, year, 2 years, 3 years away from liquidity, they've been tracked very, very closely by public market investors, okay, who are crossover investors and who invest sometimes in privates as well. So some of these companies are not unfamiliar assets, to these guys that, hey, one day somebody's filed a DRHP and, then I get to see them for the first time. So these companies have been very, very consciously tracked for the last 2 or 3 years. Their stories have been well digested. The kind of matrix that we typically look for, stuff like unit economics, stuff like cohorts, okay, which public market investors or the analyst universe typically didn't look at, they are again becoming a lot more mainstream. Okay, so there's an appreciation of the vantage point that typically private market investors had towards these companies, and B, that 2 to 3 year time frame of getting familiar with some of these companies before you're asked to vote with your money. Okay, that's again made a big difference. So I think it's no surprise. It's been in the works for some time. It's just that some of these IPOs or prospective IPOs are grabbing headlines today than they would have, say 2 years down the line, because it was still a lot of work in progress.
Fair And I want to pull in Devang here in this conversation to talk about the kind of profitability that bring that, loss-making companies. There are plenty, of course, in these new age companies that exist out there. So do you think investors are going to overlook the fact that, at one point in time, Indian investors have that mindset that the company needs to be profitable to be able to or to want to invest into it? Do you think that perspective or that mindset is changing of investors out there, where if a company is loss making, hey, it's okay, it's fine for the company to list, and we're going to put our money into the company? So, what do you think would be the reasons perhaps for that?
Yeah, I wouldn't say profitability is not important. I think as long as there is a plausible path towards profitability, growth metrics like the ones mentioned are very important. There's concepts in economics called platform economics, which has been, companies like Amazon.com or Salesforce have really done well at. They essentially become a central platform for retailing or for collaboration or for sharing information. If you're approaching platform economics through unprofitable means, it still could be a great story from a stock standpoint. And I think once investors, retail investors, institutional investors understand this, they will realize that there comes a time when you will be in a near monopolistic player or a very dominant player in a market with little competition, little price pressure. Look what Amazon is doing again. Going back to the same example, initial years they kept on investing, putting money back into growth. And at some point, there's just little competition. People are thinking the same way in terms of people are also looking at millennials, the way the millennials will live in the future, how they live, how they share, how they move from point A to point B, how they consume food or other consumables is very different from previous generations. And the companies that have the technology to address these needs, the needs of these millennials, will have to reflect this in their growth trajectories.
See, the entire concept of a loss-making company is actually a gross oversimplification of the operations of that entire business and the business model that they actually have. If you look at a tech company, for example, their assets, if you look at the asset side of any technology company, it basically consists of cash. It consists of some amount of computers or servers or some amount of consumables. A large amount that's now actually moved to the cloud, thankfully. And the last thing it actually consists of, I would say, is just like other investments or securities. There's very little else actually have in terms of hard assets. All the technology, the code base, and everything they've created is always expensed out throughout the entire year. If this was a traditional industry in terms of a manufacturing concern or something, all that would actually count as an asset, because all the code and everything that they've written, they're deriving the economic value of that over years and years and years. But they actually write all of that off. So that's one of the reasons why the technology companies are actually loss making. The second reason why they're actually loss making, if you look at it more closely, is because of the fact that the economies of scale fully haven't actually come to these particular businesses also. From a gross standpoint or from an operating standpoint, Zomato has amazing margins for that matter. If you look at any of the SaaS companies, be it a Freshworks or anyone else, their margins are usually about 70 to 80%, or even the gross margins for a business like Zomato is about 55, anywhere between 40 to 55%, depending on the cohort, depending on the place where they're in. The greatest drivers of loss are one of the analysis that all investors have to do. And Zomato as well has been very upfront about the fact that they are actually investing heavily into the businesses through increasing discounts as of now, because they're creating a behavioral pattern in all their consumers. Even during the lockdown as well, a large number when all that heightened uncertainty happened, a number of us felt elated at the fact that you could open up a Zomato or a Swiggy and see all your favorite restaurants actually coming back in time. It was a sign to the entire market, entire country, that things were slowly actually trying to get back to normal. And these are the stickiness that's happened right now is immense. Now, for all of us, you think about food, you only think about a Swiggy, you think about a Zomato. Previously, all of us would think about opening our phone book, going and calling some number of some restaurant and trying to haggle, trying to get change and all that. Our behavioral patterns have completely changed. And these startups have actually engineered this change in the behavioral pattern. So the discounts will actually slowly go away in time. We've all seen when Amazon or Flipkart, when Amazon came to India, the discounts were huge. Now the discounts are actually going away to a large extent, and none of us are actually changing our behavioral patterns. So those are the kind of investments they've actually made into the business. And when investors, such as the people on this call, as well as the public market investors, look at these particular companies, it's not just the fact that they're a loss-making company that actually matters. What are the loss drivers for these companies? How quickly can these loss drivers actually change? Have they actually engineered a behavioral pattern shift that ensures that these companies now become almost like household staples, and these become the staples of the modern economy. So that's how investors actually look at it. So, and that's where we actually dissect the entire loss. So even though the headlines actually seem as a loss-making company, they burn 3,000 crores, 4,000 crores, or some absurd amount of money like that. If you were to actually recast their financials the way you would analyze a manufacturing concern, their profitability actually starts coming into play over there itself, because the assets that they've actually created in terms of a loyal cohort, in terms of a code base that can be used and leveraged over multiple orders over multiple years. All this actually feeds into the entire thesis of investments into these particular companies, and that's how investors also view these particular companies and these sectors as well.
Right, I want to talk about the valuations at this point in time. The market is abuzz with how high the valuations have been for these companies. Unbelievable numbers floating around out there. I want to bring you in, Kashyap. You are the one who also talks to a lot of companies and also helps them come up at certain valuations for their businesses. So how is the valuation game playing out there, Kashyap?
So Priya, let me give you a very, very simple example here. Okay. So P&G, which is probably among the largest, FMCG consumer CPG companies in the world, in the US, okay, it trades at around 4.5 times their sales, around 25 odd times, price to earnings. Now you look at India, a company like an Asian Paints or Unilever, okay, it trades at, what we call internet valuations, okay, 7 to 11 times price to sales, 70 to 100 times P2E. Now, are these companies expensive? If they are not, then the digital companies that are going public are not expensive either. Now, why are these companies trading at the kind of valuations that they are? A, because they have very, very strong and charismatic brands. B, because they're respective market leaders. So if I were to take example of, say, a Nykaa or a Policy Bazaar, which are due to go public soon, or a Zomato, right? These companies operate in near monopolies or duopolies, right? When it comes to their markets. And again, these are like phenomenally strong brands. So, and B, one thing that people miss out on when one looks at DRHP, is that, let me take the example of Zomato, for instance, right? The last number that you see on DRHP is a number that's 6 months old, okay? FY21. Now, ever since then, in the digital world, that's prehistoric, right? Ever since then, the companies would have taken would have grown by leaps and bounds, especially a company like Zomato, which grew, 3x year on year and 2x year on year, right? Before the pandemic struck, and, their revenue came down by a little. So when you look at, some of these, prehistoric numbers, you end up, judging the companies on, a lot of things that you should not. B, if you look at, some of their other public market peers and compare them to, some of the older companies, in the West, you would see why these companies, command the kind of premium that they do. And, eventually the beauty of public markets is that they operate in a very, very different way as compared to private markets, right? In a private market, if a distressed shareholder, shares, sells their stock, okay, it doesn't affect, the rest of the shareholders. In a public market, every day the company is being judged and, people are voting with their money, okay. In the short term, obviously, as they say, it's a voting machine. And, people have voted with their money. It's out there to see, who am I to argue whether these valuations are rich or not, right? People are comfortable with that and people are buying more.
I think, see, from a technology company perspective also, Happiest Minds has a PE of 133. If you compare that to its closest comparables in terms of Infosys or anyone, that's an eye-watering PE. In fact, most of the private market investors actually look at the public market multiples and our eyes are watering, saying, why can't some of our early stage companies actually get that? Especially as an early stage investor, those kind of multiples are actually absurd. So the absurdity in terms of the multiples is not completely endemic only to the private markets or to startups for that particular matter. The multiples that all these companies get is actually a function of the optimism of the business model, as well as the execution capability of those particular investors as well. Nobody questions the larger companies, and Asian Paints, mind you, has had an eye-watering PE for the longest period of time. And this is in spite of the fact that now you actually have other paint companies like Indigos, etc., actually coming in. The reason why they get these high multiples is twofold. Number one, the optimism, like I said. Number two, the sheer monopoly power that it actually do evidence. Asian Paints had a near monopoly on the entire paints industry for the longest period of time. Similarly, when it comes to HUL in India, these are reasons why investors give them these high multiples. Similarly to a Zomato as well, it's a virtual duopoly. There's a Zomato and there's a Swiggy. Zomato is the only one that's listed right now, and Swiggy comes as well. That kind of competition and that healthy tension is going to actually punctuate that entire market. For a market as large as food delivery and consumption in this country, where the amount of consumption throughout is actually increasing day on day, throughout the entire place. It stands to reason that moments are discounting the future cash flow that these companies can actually generate. These are the kind of valuation numbers that the people actually end up getting. And if you combine this with a large amount of global liquidity and chasing of growth, as I said about previously as well, it makes a very heady cocktail for this. When the tide actually recedes, and all of us on this call know that this sort of federal action and this sort of global high in terms of liquidity will actually recede at some point in time. As the fundamentals that actually drive these companies actually start coming to the forefront. And for a technology company, given the fact that the amount they can actually sweat that asset in terms of the code base over a longer period of time, and maintenance is not as high as actually the creation of it, and the marginal cost of running these particular kind of businesses is almost negligible for that matter. The sheer amount of cash that these companies can actually end up throwing as a software product, as a platform, is actually the global comparables for that is like a Microsoft or a Google, right? So when people actually start looking at these kind of matrices, people actually take into consideration this entire view, and they start looking at the stronger fundamentals of these particular companies. They stand to reason that the valuations can actually end up getting justified that way.
And the other thing, really, to chime in really quick, we spoke about liquidity and the supply and demand. It's important to note that all the favorable geopolitical tailwinds that I think are helping the Indian tech sector a lot. You look at the number of IPOs from, let's say, China that are getting literally yanked from Wall Street and other exchanges because of trade spats and things like that. You see that money, right? Money, only a finite amount of money can go into US assets or UK assets. For sheer diversification purposes, a lot of that money has to go to someplace in Asia, and India is clearly the best market to go. So aside from real estate, due to obvious reasons, I think many asset classes in India have gone up, the prices, because of this sheer money, the sheer volume of money that is sloshing around looking for growth.
Right. I want to come to closing comments from three of y'all on the fact that, yes, there is it's out there. And do you think that's going to continue to pump growth and acceptance for these new age items? 20 companies that went ahead and filed a DRE. It looks like a lot of IPOs out there that are going to hit the market very soon. So just a closing comment from each of you on what the future of the IPO market looks like. Can we expect a flurry of more companies going ahead and listing, and is this the right time because there is a lot of cash in the market clearly? Kashyap?
Yeah, so what I would say is that everything said and done, when you compare these companies to the larger universe of listed companies around, right, which is what their benchmark against, there are 2 or 3 aspects in which these companies trump most of them. One is growth, the other is corporate governance, okay, and the third is the potential longevity of these businesses as compared to many of the traditional businesses that are listed on the bourses right now. Now, my opinion is that almost all of these IPOs would sail through. In the medium to long term, not all of these companies would be able to sustain these kind of valuations because becoming a public company comes with its own scrutiny and challenges. But my bet is that at least 3/4 of these companies would go on to pass the public market muster in the next 2 to 3 odd years or so. And I see most of these IPOs sailing through without any problem.
Yeah, I think I agree with Kashyap largely. I think as long as what I call the first principles remain in place, a growing and buoyant stock market, driven by classical companies, let's say Reliance, Bajaj Group, and things like that. As long as the index stays high, then the market in general remains optimistic. As long as tech startups hit the growth stride in the way Zomato or Paytm or Policybazaar did, they'll remain viable candidates to hit the stock market. And as long as the investing fraternity of both retail and institutional investors understand the economics of a growing tech company as different from a traditional chemicals or manufacturing company, I think the demand will remain very high, and it would be a great change in some way for the Indian stock market.
So speaking as an investor, an IPO has actually gone from being a possibility in most of our documents to actually become an inevitability as of now. And I think that actually shows the maturation of the tech industry and the fact that the wider world in general has accepted the fact that technology is going to become the dominant theme over the next 100 years or at least throughout our entire lifetime as well. So most of the startups are going to be IPOing out right now. They will actually, it's actually a fantastic thing for the entire market. It shows that the market's starting to accept them. But that being said, the one caveat for all investors, for all entrepreneurs who actually IPO is the IPO is not actually the end goal. The IPO is just the beginning of an entire journey in the public market stream, and there's going to be a much tougher journey as well. Because, like Kashyap mentioned, it's essentially a voting industry. It's almost like a beauty contest, right? The moment you actually out of favor, for example, no one's actually going to start looking at you, and your ability to actually raise capital actually goes away to a large extent. And your eye-watering fees, your multiples, everything actually comes crashing down. I mean, it gives you to the highest of the highs and the lowest of the lows. So the people who can actually maintain strong governance, the people who can actually maintain their growth, people who actually communicate their strategy effectively to the market. The way Bezos did in 1997 when he said that we're not going to be making any profits anytime soon. I'll reinvest every dollar back into the business, but we'll become the largest there is. So the ambition and the drive of these entrepreneurs is going to come out to the forefront, and combined with these other aspects I spoke about, they can actually become the dominant theme in our sectors as well. We've already seen Infosys, the vanguards in terms of Infosys, Wipro, and the rest, and the India's IT and ITS services giants actually come up. Now it's going to be the product companies, it's going to be the platform companies, it's going to be everyone else who are actually going to piggyback and stand on the shoulder of those giants. Going to come out to the forefront, and India is actually going to become far richer for that as well. And that's a future I'm looking forward to.
Right. On that note, gentlemen, thank you very much for your insights and for this very power-packed discussion. I'm sure the audiences have enjoyed this as well. Thank you so much for your time, and thank you so much for being a part of the Daily Dispatch.
Thank you.
Well, time now to wrap up this edition of the Daily Dispatch. I'll catch you tomorrow at 5 p.m. Goodbye and have a lovely day.